Closing procedures and monetary settlements. Role of licensee. Real estate licensees' involvement in a transactional process hardly ends when the parties create a contract for purchase and sale. The licensee plays a key role in the execution of that contractual agreement by working with closing attorney to provide that party with a true copy of the sales contract and any other necessary documents to facilitate the closing process, confirming with all transactional parties the closing date, time, and location according to the terms of the contract and the attorney's schedule. So you have to make sure everybody's on the same page. Everybody's communicating. The buyer is aware of everything that's going on, what is needed from the buyer, if it's been communicated to the buyer. You still play a role in the closing process. Monitoring performance of all legally binding promises made by contractual parties, as well as compliance with transactional contingencies. Competently responding to clients' questions regarding the procedures and settlement calculations in a process. This may also include updating estimated net to seller forms or estimated costs for buyer forms. The licensee have provided for these respective clients during the transactional process. So again, as the agent, as a licensee, you are there to make sure everything is going smooth, to satisfy to calm your buyers or sellers' nerves, and to make sure that this process can go as smoothly as possible. Role of closing attorney, as the primary purpose of a real estate transaction is the legal transference of title from the property owner, which is the grantor, to the new owner, the grantee. Georgia Supreme Court has confirmed that only a licensed attorney is authorized to prepare and execute a deed to complete that title transfer or to facilitate the signing of such. So in Georgia, only the attorney can close the deal. If a new loan is involved in the closing of a real estate transaction, the closing attorney will represent the lender. If it's a new loan, closing attorney represents the lender. Shortly after receiving a true copy of the sales contract, the closing attorney will arrange for a title examination. The title examiner will conduct a proper property ownership history search that covers a 50-year period with the grantor-grantee real property index found in the public record, providing the necessary information. The examiner would be looking for any documents that might negatively affect the property's title. So all of that is going on behind the scenes with the title company. When the search is completed, the examiner prepares a title report or abstract for the closing attorney's review. If the title is found to be free of serious defects and sufficiently marketable for an insurance company to issue a title insurance policy, then the new owner, the grantee, may consider that evidence as proof they are receiving a good title. And that's all a new owner wants to hear, that it has cleared, we're good to go, there's no defects, and we can move forward with the closing. Once good title to the property has been confirmed with the true copy of the sales contract and the buyer's new loan package from the underwriter in hand, the closing attorney's office will complete the settlement statement, calculating the debit and credit sums to the buyer or seller. Closing disclosure form must be received by the consumer 3 days prior to closing. The form identifies and itemizes those funds necessary to close the real estate transaction. 3 days. These monetary sums display the amounts each transactional party will have to pay out, debits, and receive credits. These items are commonly categorized as closing costs, prepaid and accrued items, and payoffs of existing property owner loans. Closing costs are generally fixed monetary charges, primarily associated with closing the loan or other costs to the parties as part of the contractual agreement. Accrued prepaid items, not to be confused with fixed sums identified as closing costs. These charges are paid in advance, prorated, or escrowed at closing. So prepaid items would be such things as like your credit report, the appraisal, some insurances sometimes, HOA sometimes. It just depends. Property tax, in prorating property tax between buyer and seller at the transactional closing, the day of closing is responsibility of the seller. So seller owns day of closing. In calculating days of taxes within a calendar year, the year will typically be based on a 365 day and the actual number of days in a specific month. However, if questions on the exam instruct you to use different numbers, always follow those instructions, because there's also such a thing as 360-30. There's a 360-30 day rule, and then there's a 365-day actual day. So if it's the 365 an actual day, for example, February, we just had 28 days in the month of February. So we would use those actual days to help us calculate the prorated amounts. Property taxes in Georgia have different due dates depending on in what county the property is located, on whichever date the taxes are due. However, they are always paid for the full calendar year, January 1st through December 31st. For exam purposes, the due date for property taxes, if given, will typically be July 1. If a closing date occurs prior to July 1, then taxes have not been paid for the year, and the seller will owe the buyer days of taxes, beginning on January 1 and counting through and including the day given for the closing. Okay, so again, if the closing date occurs prior to July 1, then the taxes have not been paid, and this is for exam purposes. The property taxes have not been paid for the year, and the seller will still owe the buyer days of taxes beginning on the 1st of January and counting all the way through until the day of closing. Okay? On the other hand, if the closing date takes place after July 1, that means the seller has already paid the full taxes for the calendar year. So the buyer will owe the seller for days of taxes beginning the day after closing and counting through and including December 31st of that year. So that's if the seller has already paid the taxes. The buyer will most likely owe the seller money. Side note, read every proration problem on any examination very carefully. The question may provide you with a different due date for taxes. The same basic principle applies. If a closing takes place on or before the tax due date, the seller owes the buyer, counting from January 1st through closing day. If the closing date takes place after the tax due date, the buyer will owe the seller from any day after closing until December 31st. The question may even not mention an exact due date for the taxes, rather just state that taxes have or have not been paid. Again, the same principle applies. If not paid, that simply means seller owes buyer from January 1 through closing date, always provided in the question. If taxes have not been paid, then buyer owes seller for days counted from day after closing through December 31st. When prorating taxes, the formula is annual tax, whatever the amount is given for the annual tax, divided by that 365, okay, to get the daily tax rate. And then you multiply the daily tax rate by the number of days. For example, if the closing takes place on July 20th, and the annual property tax is paid on July 1 or $2,500, the buyer owes the seller $1,123.40. In this case, the seller has paid the annual tax, okay? And how they got that, 2,500 divided by 365 to get the daily rate, and then you count the number of days. And that's how you would get how much the seller has paid and the buyer owes the taxes, owes the seller. And there it is. To solve, divide 2,500 by 365, you would get $6.85. Multiply $6.85 times 164 days, which is 11 days in July, plus 153 days for August through December, equals $1,123.40. On the closing statement, the prorated taxes will show as a credit of $1,123.40 to the seller. Why? Because he prepaid the taxes. And a debit of $1,123.40 to the buyer because he owes that seller. On the other hand, if the closing takes place on July 20th and the taxes are not due until later in the year, that means as of closing date, the taxes have not been paid and the seller will owe the buyer for days beginning January 1 through closing date July 20th, which is 201 days. That's 20 days in July, plus 181 days for January 1st through June 30th. Remember, because the closing is July 20th. On the closing statement, the prorated taxes will show a credit of $1,376.85 to the buyer, and that same amount debited to the seller. That's 2,500 divided by 365 equals $6.85 times 201 days equals $1,376.85. Settlement calculations continued. Monthly payments on real property loans. Though loan payments are most often due on the first of the month, sometimes payment due dates may fall on another day of the month. The interest portion of that monthly loan payment is always paid in arrears rather than in advance. For example, if a loan payment comes due on May 1st, the loan interest portion of that loan covers interest for April 1st through April 30th in arrears. But if a loan payment due date falls on May 15th, because interest is always paid 1 month in arrears, the interest portion, if that payment will cover April 15th through May 14th. As for the month in which a buyer's first loan payment comes due, that is determined by the closing date. If a closing occurs on any day of the month other than day 1, then a full month is skipped before the first loan payment comes due. If, however, the closing date falls on the first day of the month, the first payment comes due on day 1 of the following month. As examples, a closing on May 1st results in a buyer's first loan payment coming due on June 1st. It skips a month. A closing date of May 15th, though the month of June is skipped, and the first payment falls on July 1. Accrued, prepaid, adjusted interest prorations. Typically, a closing attorney will be prorating interest for 2 loans on a settlement form. Accrued interest on the seller's existing loan and prepaid or adjusted interest on the buyer's new loan. Returning to our previous examples as illustrations for proration of these 2 types of loan interest, assume the closing date is May 15th. Examining the seller's existing loan, when the seller made their last monthly payment on May 1st, the interest portion of that payment covered April 1st through April 30th. Since that last payment, daily interest has been accruing from May 1st through May 15th, closing day, as the property sale is closing on May 15th, the seller will not make a June 1st payment that would have covered loan interest for the entire month of May. Therefore, in the closing settlement form, the seller is owes lender 15 days of accrued interest. As for the buyer's new loan, if the closing is on May 15th, the first payment of that loan falls due on July 1st, which pays in arrears loan interest for the month of June. But starting on closing day, the daily interest due on the buyer's new starts, so that the buyer will have to prepay that adjusted loan interest from May 15th to May 31st, 17 days to the lender at closing. The formula for prorating accrued interest is loan amount times rate of interest equals annual interest divided by 360 equals daily interest times the number of days owed. Example. Assume seller pays on a loan of $225 at 3.4% interest, and the date of closing is May 15th. The seller's prorated accrued interest from May 1st through May 15th is $305. That's $225 times 0.034 equals $7,650 divided by 60 equals $21.25 times 15 equals $318.75. Here is the formula for prorating adjusted prepaid interest on the buyer's new loan. Loan amount times rate of interest equal annual interest. Annual interest divided by 360 equals daily rate. Daily rate times number of days owed, closing date through the end of the month. For example, assuming the closing date on a buyer's purchase with a new loan of $340,000 at 3.4% interest takes place on May 15th. The buyer's interest adjustments for the period May 15th through 31st is $545.89. $340,000 divided by 0.034 equals $11,560, which is the annual interest. Then you would take $11,560 divided by 360, which gives you $32.11 daily rate. Then you would multiply the daily rate of $32.11 times 17, which gives you $545.89. That is the interest adjustment. Transfer tax. Transfer tax is my favorite. The transfer tax is a state tax usually assigned to the buyer, but the parties may negotiate that tax will be paid by the seller. The tax is based on the sales price of the property less any assumed loan. The tax is paid to the clerk of the Superior Court in the county where the property is located. Payment of the transfer tax is required for the deed to be recorded. The tax is 10 cents per $100 of the sales price or a portion thereof minus the amount of any assumed loan. A new loan is not deducted. The sales price is divided by 100, rounded up to the next whole number if the result is not a whole number. Multiply that by 10 cents. The formula for determining the transfer tax is as follows. Sales price minus assumed loan, if any, divided by 100, if necessary, round to the nearest whole number, times 10 cents. Example, assume that the sales price of a property is $450,000 with an assumed loan of $150,000. The transfer tax is $300. That is $450,000 minus $150,000 equals $300,000 divided by 100 equals 3,000 times 10 cents equals 300. Intangible tax. The intangible tax is a tax on mortgage notes of more than $1,500 secured by real estate for a term of longer than 3 years. The tax is based only on the amount of the new mortgage. The tax is paid to the county in which the property is located. The tax may be paid by either the buyer or the seller. The rate is $1.50 per 500 or a portion thereof of any new loan. There is no intangible tax on an assumption. If the purchaser is obtaining more than one new loan, the tax is computed and paid on each loan separately. If in determining the tax, dividing the loan amount by 500 results in a fraction, round up to the whole number. The formula is the new loan amount divided by 500, rounded up to next whole number, equal taxable amount times $1.50. For example, assume that the new loan on a property is $340,000. The intangibles is $1,020. So 340,000 divided by 500 equals 680. Multiply that by $1.50 equals $1,020. For buyers and sellers, closing day is the final step in the transactional process. All special stipulations and other contract obligations should be fulfilled by this date unless the contract terms include a survival clause providing for a later date of completion of such provisions. At the closing, the seller signs the deed transferring title to the property, as well as any affidavits required for title purposes, while the buyer transfers those funds agreed upon in the contract to the seller. For real estate licensees, closing day is typically when the brokers involved in a sales transaction receive their commission checks. Oh, happy day. If a loan is involved in the purchase of the property, the buyer will sign the promissory note, the deed to secure debt, security deed, and any other lender-required documents. The closing attorney or a law firm member will commonly carry certification to notarize these documents. Witness signatures for these documents are also required. A transactional real estate licensee present at the closing will often provide that service. In addition to making sure all the documentation is properly handled and that all parties have copies of the final settlement statements, the closing attorney also functions as an authoritative source who may provide answers and explanations for questions posed by buyers and sellers. As most closings usually involve a loan as part of the purchase price, and as the closing attorney in Georgia will represent the lender, the attorney is not able to provide legal advice to the buyers and sellers. Unlike many other states who allow escrow closings where the presence of the transactional parties is not required, closings in Georgia, absent power of attorney circumstances, are face-to-face with all parties present. A broker may be present, but customarily the sales affiliate attends the closing as a representative of the broker. Real Estate Settlement Procedures Act, RESPA, federal law enacted to protect consumers in the settlement process, requiring accurate and timely information about the actual cost of the transaction, eliminating kickbacks and other referral fees related to the closing process, prohibiting the seller from requiring the buyer to buy title insurance from a particular company, and prohibiting sellers from requiring excessive escrow deposit accounts. Georgia Residential Mortgage Fraud Act, the first statutory legislation of its kind passed in the U.S. The law addressed two basic categories of fraudulent real estate activity: fraud for property, and fraud for profit. Fraud for property committed by borrowers providing false income or employment information in order to qualify or receive a better term for a home loan. That's a no-no. Fraud for profit committed when professionals in real estate and the lending industry conspire to realize profits from misdeeds. The Georgia mortgage fraud statute makes mortgage fraud a felony, and if that felony is part of a conspiracy pattern of fraud, punishment upon conviction may be imprisonment up to 20 years and/or fines up to $100,000. The Residential Mortgage Fraud Act applies to real estate licensees who knowingly receive commission checks as part of a fraudulent process, even if licensee did not actively participate in the illegal actions. Consequently, it's important for licensees to report any suspicious lending activity or potential mortgage fraud to their broker, local authorities, or state attorney generals. To avoid any perceived connections to mortgage fraud, licensees should be on the outlook, especially at real estate closings, for one or more of the following: buyers paying substantially more at closing than indicated in the contract price, loan amounts for substantially more than the contract purchase price, settlement charges that were not listed in the final loan estimate or closing disclosure forms, lenders or closing attorneys directing buyers and sellers to leave signature lines blank on closing forms, buyers selling property shortly after closing on that property for a substantially inflated price, or any parties involved in loan process receiving unusual payouts or kickbacks of any kind.